We will now have a presentation fulfilling the potential of protected cell companies in Asia. We have two presenters this time. First of all is Alastair Nicoll, the Regional Director of Aon Insurance Managers APAC. He recently relocated to Singapore to lead Aon's captive practice in Asia Pacific. He has more than 30 years of experience in the insurance industry with Aon, having operated in 3 main markets before Asia. Before moving to Singapore, he led Aon Global Risk Consulting and Captive Management Team in Dublin, Ireland. Meanwhile, the second presenter will be George Ong, who heads the Aon Singapore Captive Practice with overall responsibility for the management and servicing of its clients and has 20 years of experience in the insurance industry, having served in various capacities in the area of finance, compliance, consultancy, and audit roles. Ladies and gentlemen, please give a warm welcome to our presenters.
Good morning, everybody. Thank you all for coming back from the coffee break. I think this is about the fullest room I've seen at this stage of a conference. Usually day 2, the numbers dwindle. But if you reflect back on yesterday and this morning's session, nearly every session has talked about protected cell companies. There's a little bit of a mystique about protected cell companies. And what George and I would like to do over the next 40 minutes is to give you a brief introduction to what protected cell companies are, how they can be used, and also look forward. We're looking forward in particular with respect to Asia Pacific and how we see that as being a potential for growth. But the first thing I'd like to do is just to put up the standard question. If we could just roll that here. Could you please just slip into the app and have a look at the options up there and just give us a feeling for your level of interaction in the past with protected cell companies. And while those numbers are going up, we'll leave those up there. I just want to also connect with a little bit with the comments that have gone up to now. First thing is, I don't think we can compete with the level of SOX that the panel before had on, Malcolm in particular. But George is going to give it a fair try. With regard to golf in the domicile analysis, when I went to Bermuda in 1986, my handicap was 24. When I left, it was 12. So I guess it worked for me. And I think that was a key contributor to why I was in Bermuda for 9 years and not the 18 months that I signed up for. And the third reflection is on experience. There's been some very experienced panelists talking about captives up to now. We've heard of 30 years experience, we've heard of 40 years experience yesterday, but between George and I, we've got 50 years of experience. So we always like to be bigger and better. So hopefully we can use some of that experience to share what we know about protected cell companies. And looking at the results up here, most have heard of them, some have experience of working with protected cell companies, and some people are asking, what is a protected cell company? So we'll try to answer all of those questions. So if we move on to the agenda. As I said, lots of jargon up to now. Insurance is full of jargon. Captive insurance is full of jargon. We've heard about, what did we hear about in the last session? CFC, Controlled Foreign Company Legislation. We heard about 831Bs and 953D elections in the US, and now we're introducing PCCs. And the bad news is it's not just PCCs, they're SACs, SRCs, SPCs, ICCs. So you're going to get lots of letters, lots of acronyms, but just think about them as being cells. And the other thing I want to say at the start is that this isn't a competition with captives. George and I have been in the captive business for a long time, as have a number of the other panelists. This is in addition to captives. Captives are the core. And if you look at our firm's global book, about 85% of our business is captives. 15% or so and that would be pure captives. And then there are association captives, mutuals, and then there are also protected cell companies that make up the rest. So although it's a minor part, it's an evolving part. And as I'll explain in a second, it's been around for a while, but it's probably underutilized. So I'll explain the history, where they've come from, and where we think they're going to go to. We're also going to talk about the way that we use our protected cell company to provide solutions to our clients on a global basis. And then towards the end of the session, we're going to focus in particularly on Asia, and we think there are 2 key ways in which we can try to drive growth in the region by using cell companies. And as always, please feel free to ask questions as we go through. So this is a bit of a busy diagram, and I think it's kind of hard to use this. I'll use this later. But I want to go back to my Bermuda days. When I arrived there in 1986, I'd never heard of insurance, never really heard of a captive. I was an accountant starting to work in the business, quick learning curve to get up to speed. And in the background, there were these things called rent-a-captives that are up here at the very start of the curve there. So they were ways in which companies came together, or smaller companies used a facility to retain risk, as opposed to pure captives, association mutuals. However, there was a bit of a flaw, a potential flaw with those, as they weren't protected by contract. So the rent-a-captive concept was common, as I said, with smaller companies, groups of individuals joining together to form captive-type facilities for their common use and benefit. The weakness, though, was no legal segregation of the various different assets and liabilities that were attached to that business. And because of that, the adverse performance of the insurance programs within the rent-a-captive could adversely affect the other participants. A protected cell company is a company with a structure that creates a legal segregation of its assets and liabilities into a number of different cells and a central core that I'll talk about in a second. The purpose of this arrangement is to ring-fence the different cells and the assets and liabilities within those. Hence, other than the segregation provided under the contractual arrangement, there is now an added layer of statutory protection as provided under the cell legislation. The cell legislation has also been introduced in many other countries, and we've just got a graph here that shows a few of the earlier starters. So Aon set up the first protected cell company in Guernsey back in 1997. 1997, who remembers that? 21 years ago. So we've had protected cells for 21 years. And we'll talk about how they've evolved. And over time, other domiciles have followed along. They've copied the legislation, and one by one, they've improved the legislation. So they've found unique reasons for using cell legislation and added on another layer of benefits to the users. And gradually over time, all the big players in the captive world, the Caymans, the Bermudas, the Vermonts, and then into Europe and the European Union, you've got the Gibraltars and the Maltas, Isle of Mans and the Guernseys. And in 2010, Labuan, to their credit, formed protected cell legislation. And that, as we'll talk about a little bit later, has developed over the course of the last 8 years. So it's a big picture. At the top there, it mentions that there are 45 plus. I'm not actually sure how many domiciles have cell legislation, but it's kind of common. But one or two key domiciles, such as Dublin, where I operated before, don't have cell legislation. They didn't have the vision to set it up at the time to be competitive. And I think their view now is it's kind of late to be doing that. So having cell legislation is the first piece of the puzzle that you need to have in place. So I'm going to dive into the deep end here. See if this works. So in the middle there, you see this core bit. The first thing I'm going to just mention is that there are two different levels of capitalization within a protected cell structure. There's the core in the middle, and that's typically financed by an owner. In our case, Aon put in the capital to take on the ordinary stock in the protected cell facility, and therefore we own the core. The second level of shares, if you like, would be within each of the different cells. And in our structure, all of the cell owners just need to buy one preference share. So once you buy the preference share to cell 1 in the top right-hand corner there, you would own that cell, and that becomes your facility to use for your own risks. Just in the same way as if you had your own captive, but with a different level of barrier to access it. Cell 1 and cell 2 will be segregated by the legislation between each other, as will 2 and 3 and 4. So there's no risk sharing. It's all isolated within your own cell, and your performance doesn't and cannot have the potential to taint the performance of another cell. There's no limit to the number of cells that we can have. Over time, since 1997, we have formed, and some have closed down, over 300 cells. So the cell number is limitless. So once you've formed the core and you have the company in Labuan or whichever of this 45 or 50 domiciles, you can then add the number of cells to whatever length you like. And as I said at the start, the creditors of one cell don't have recourse to the assets of another cell. So it gives you that protection, protected cell companies. And the final point there, I talked about all the different names and the acronyms. If you look on the right-hand side, each of the different domiciles, as they set up the legislation, would come up with a new name. So from segregated portfolio companies in Cayman to segregated asset companies and all the different names. A few of them are up there, so just think of them all as cell companies. We were talking to some companies in Kuala Lumpur at the start of the week, and they are either exploring captives or they have a captive. And one of the things that they were telling us is that oftentimes when they're talking to friends, other risk managers, they don't see themselves as being a viable proposition for starting up a fully owned captive because they're too small. There seems, that's one of the key barriers. The amount of premium volume, I think even one of the panels was tested yesterday, nobody would come up with a number. $12.50, I think somebody came up with $12.50. Maybe it's a bit more than that. So you need capital to start up a captive. You need premium to fund into it, to fund the risk that you're retaining. And then there are also operating costs, both in setting up the company and in operating it on a year-to-year basis. And what the cell does is it gives that second tier, SME type level of company, an opportunity to set up their own cell, their own facility to self-insure risk. Some of the advantages and a couple of the cons up there, and I'd just like to run through those. First one I've mentioned, suitable to various size companies. In the previous panel discussion on domiciles, they were talking about attending board meetings. And for instance, in Dublin now, all of the captive board meetings need to be held in Dublin. So if your parent company is in Chicago, they come to Dublin for the board meetings. That's a huge time waster or time intrusion for the board members that are attending. There's also huge value that's added from that as well. And as I say, we're not competing against captives here. But one way to avoid that is to operate through a cell. You can have many of the same benefits without having the same intrusion on the management time. With respect to capital as well, there's less of a capital requirement. A lot of the minimum requirements that are mentioned in domicile analysis will be the minor amounts, like $120,000 in Bermuda, 400 Sing dollars in Singapore, etc. But the actual amount of capital you need to post is much bigger than that because you need to have enough capital to cover the risk that's retained. Another item is speed. And again, this came up yesterday. It can take 6 to 9 months to set up a full captive. By the time you engage a consultant, you do a feasibility study, you look at all of the options, the company's ability to and tolerance to risk, its risk appetite. You provide, at the end of that process, a business plan. That then needs board approval at the group level. That all takes time. And then after all that, you need to put in an application to the regulator to have the company formed. Honestly, that's a 6 to 9 to 12-month process, depending on how quickly you go at it. Whereas with this structure, if you remember the core's already there, the structure's in place, and you're up and almost ready to run. So speed in entry. So as you get closer to your renewal date, if you need a structure and it's too late to form a captive, a cell can provide that facility. And lower operating costs. Simply, if there are 150 cells in the protected cell company, you're sharing the costs by 150. You're not paying them all yourself. So it's a lower operating cost, both for entry and so it's quicker, cheaper, and easier to use than a full captive. On the other side of what we've called considerations, you need to fund the risk gap. So just a quick illustration on that would be if you were retaining about $1 million of risk and you were funding that with $1 of capital, it's not going to help very far to cover the risk gap, but some premium will go in there. Let's call that $200,000. So you've got an $800,000 or so risk gap. That needs to be covered, typically by any form of collateral. Letters of credit are used typically. So the risk gap is closed. And again, that provides the protection between the cells and also the protection to the core. And control, there's some loss of control. All of what I was talking about at the board of directors, that's gone because the core board of directors run the company. You don't need to attend the meetings. So there's a bit of a lack of control over the way that the whole facility could be run. So I'm going to turn now to the way that we use White Rock to provide solutions to our clients. And I put up 5 main solutions there. And I'm also going to point out that we have our locations in Bermuda, Gibraltar, Guernsey, Isle of Man, Malta, and Vermont. And there are key business reasons. That's because our clients asked for facilities to be available in those territories, and we've responded by making them available, and then they've been used. So we don't set them up as empty vehicles and then wait for companies to come. They're responding to clients' needs. And as I said, we've set up a few over the years. So the ones we're going to talk you through are fronting, retention, warehousing, collateralized reinsurance, and market access. First one that's up there is fronting. And although this mainly reflects on European Union, many Asian companies have global businesses. They're not just based in Asia. So think about the Asian companies, perhaps the SME type companies that have a global flow to their business. And this is how it could be helpful. So it's most relevant in the European Union, where an insurer domiciled in any of the EU jurisdictions is allowed what we call passporting rights to underwrite across the European Union. And that can be done, for example, from Malta. For Asian clients that have a global insurance program and have significant presence in the EU, this represents an alternative to the traditional fronting agreements with international network carriers. Instead of paying a fronting fee and collateral to the fronting insurers, clients can set up a cell to underwrite risks across the European Union with costs comparatively cheaper and collateral-free as compared to a traditional fronting insurance arrangement. The second one is retention, and this is what has been referred to before as a mini captive, and maybe the most relevant for the Asian market. Similar to the solution provided by a traditional captive, with the advantage of having a risk retention platform without capital or management time required, as I've explained. Cheaper, quicker, easier. This is ideal for companies who are unsure about forming a captive and may not be willing to commit the amount of capital and cost that are required to form a captive. The cell solution provides the companies with a platform to get first experience of operating a self-retention vehicle, using the cell as an incubator for new risk until performance has been measured. And once a company is familiar and comfortable with operating a risk retention vehicle, it may then convert the cell captive to a fully fledged captive. The third one is what we call warehousing. And again, this was mentioned yesterday. There's a lot of focus on setting up captives. Captive lives are usually 10, 20, 30 years. A lot of them are still running. Eventually, captives need to be closed. And when you close them, you need to de-risk them. You need to de-risk them in order to liquidate the companies and get your license back, and most importantly, get your capital back. So for people who have been involved in shutting down a captive, it's not a very straightforward process. And depending on the type of risks that are underwritten, where the captive is domiciled, and the jurisdictions in which the risks are located, the process could be long and tedious. And until a captive's closed, there will still be operating costs incurred and capital tied down on this run-off captive. So a cell can help to expedite the closing down process through the setting up of a cell to de-risk the captive insurance subsidiary. So you pick up the remaining residual liabilities in the captive and transfer them into your own wholly owned cell to de-risk your own captive, repatriate the capital, return the license, and exit the captive market. So we've used that for what we call warehousing of the risk until ultimately it settles. And the fourth one is access to the reinsurance market, which is similar to one of the other ones. But companies sometimes want purely to access additional capacity. They want to access the reinsurance market. It's traditionally been, if you like, cheaper than the conventional insurance market. And this is a way to do it. You form the cell as an insurance cell, and then you access the reinsurance capacity from there. So that's given you, I hope, just a flavor of the ways that we and many other managers have set up protected cell companies to help our clients. I'm going to hand over now to George. He's going to talk about the fifth solution, which is collateralization of insurance-linked securities.
Hello. Thanks, Ali. I'm glad to be here. George, if you remember last year I was here, I sort of hijacked your Q&A session to introduce our Aon app. So I told myself I'm not going to do it this year, so I'm going to redeem myself by speaking as a speaker in this conference. Yeah, so Ali has provided you with the 4 examples on how we in Aon users sell to provide solutions to our customers. What I'm going to do is to quickly run through the 5th solution, which is insurance-linked securities, and perhaps talk a bit about the growth potential of PCC in Asia. So if you look at this chart here, insurance-linked securities, this is not covered in the Slido app, but we'll do it in a very conventional manner. How many people in the audience have heard of insurance-linked securities before this conference? Show of hands. Yeah, good, excellent. Not many, okay? So I'm going to spend quite a bit of time talking about IRS in this session because a lot of the growth in PCC market that we have seen, right, is actually driven by this demand coming from the IRS market. Okay, so what is IRS really? Well, IRS or insurance securities, okay, are actually investment products, okay, and investment products that are sold to investors, and the value of the investment product is actually contingent on the insured loss events. So in the IRS space, we can see that IRS products can be broadly classified into the following categories. So we have the cat bonds, the sidecars, collateralized re, and increasingly rated reinsurance. Okay, I can spend whole days talking about this, but I only got 10 minutes. So I'll try my best. So in cat bonds and sidecars, right, these are typically what we call cedent sponsors. Okay, and the cedent sponsors could be your insurance, reinsurance company. Okay, many insurance companies or reinsurance company in this audience are actually big players in this space. So Everest Re, XL Catlin, AXA, Allianz, etc. So these companies are actually transferring a lot of the risk, okay, to the capital markets. And the capital markets would be investors from what we call the qualifying institutional buyers investors, QIB investors. So these are typically your hedge funds, pension funds, sovereign wealth funds. Okay, so and collateralized re and rated re, these are typically investor sponsors. So there are many big IOS fund managers, so the likes of Netfilia, Mount Logan, Credit Suisse, for example. So they are big IRS fund managers who manage investment portfolio for their customers. And one of the products they actually invest for their customer is IRS products. And we are seeing a lot of demand on IRS products because of the need to diversify the portfolio, investment portfolio for their customers. And IRS products generally are deemed to be what we call have a very low correlation to their other financial products. So there definitely has been an increasing demand in this space. So in the interest of time, right, I cannot possibly cover all the 4 types of IRS products. So I'll just focus on one product, which is cat bond. Okay, this is not Kuching bond. Okay, it's a catastrophic bond. Okay, and as the name suggests, catastrophic bond is to cover cat event. So this could be your earthquake, it could be your hurricanes, it could be your typhoons. All right, and in a typical cat bond structure, what we'll see is that the sponsor or the cedent, so it could be, as I mentioned, the insurers, reinsurers, it could be corporates. Okay, Tokyo Disneyland has done it before. And they would pay a premiums for the insurance protection. And these premiums are parked into what we call a SPV, SPI, or SPRV, Special Purpose Vehicle. Many acronyms again. And the funds collected, is put into a collateralized account. The risk is securitized, packaged into a bond. Okay, and these bonds are being sold to your investors. Okay, so the difference between IRS and your traditional risk transfer product is, instead of transferring the risk from your to the traditional insurance market, your traditional insurers, reinsurers, you are now transferring risk to the capital market. Okay, and the investors who provide the protection will subscribe to the bond. Okay, and the principal funds collected again put into the SPV, into the collateral account. So the premiums, the principals, all put into this collateralized account that's held by the SPV, and it's being invested in typically high-yield money market fund. All right. And what we're seeing is that I mentioned what is this linkage between IRS and SEL, PCC. It's almost a standard market practice now to use SEL companies to issue or to act as the SPV to issue the cat bond. And as Alastair has mentioned, the reasons are it's a lot more flexible, it's a lot more quicker, and definitely it's a lot more cheaper to do it under a SEL structure. So as a result, there's been an increasing demand, okay, in using SEL structure for IRS products. So having set the scene, okay, on the various SEL solutions that we provide for our clients, I'll now just cover what's the growth potential for Asia in the PCC market. And before we zoom into Asia, right, now let's just examine the growth that's been happening around the globe in this SEL market. So as you can see from the chart, there has been significant growth in the demand for SEL companies. According to Business Insurance, the number of SEL companies has increased from 229 in 2007 to 1,371 in 2016. Tremendous growth, okay? And a bit of a typo error there. It should be SEL statistic, not captive statistics. If you look at where these SELs companies are being set up, top three would be Bermuda, Cayman, Guernsey. The data for Bermuda was not disclosed in the latest statistics, but based on the statistics that were available in the earlier years and the knowledge that we have gained from the local market, it's safe to say that Bermuda has remained the top domicile for SEL structures. And following that are the US onshore domiciles, places like Delaware, Tennessee, Vermont, North Carolina. Okay? So what's driving that growth? In the US, Benjamin from Deloitte he has mentioned about small captives, small companies setting up mini captives to take advantage of the 831B tax election. So that exactly is what's happening in the US, and that demand has actually provided a lot of growth in the SEL structure in the US. And as I've mentioned, the demand coming from the IRS market, okay, that's happening in Bermuda, Cayman, as well as Guernsey, okay? So a lot of the demand from SEL structure is actually driven by the IRS market in those places. In Europe as well, we are seeing a bit of growth coming from the demand of using SEL captives to convert their captive insurance subsidiary to SEL captives to avoid the cumbersome requirements under the Solvency II regime. So there's a bit of growth coming from Europe as a result of that as well. So back to the question, growth potential in Asia, where's that going to come from? we spoke about the percentage of GDP, Asia GDP in the global context. I think I have some statistic. If you look at Asia, the population of Asia PAC is 60% of the world population. GDP percentage, I think there was some number indicated 30%. I had 43% actually for APAC. So it's a big, huge economy. But if you look at the chart on the right, I mean, this is from our colleagues in impact forecasting. The economic cost, caused by net cat events in Asia, that was 59 billion in 2017, out of which only 4% was insured. And if you compare it to the statistic, on a global basis, 38% of the economic loss was insured. So how do you interpret this data? First of all, it just shows, that the Asian market as a whole is still relatively immature, as illustrated by this huge protection gap. And secondly, the growth potential. Because of this huge potential, huge protection gap, there's definitely a lot more growth, not just for the insurance market as a whole, but in relation to that, demand for the associated risk transfer solutions such as captive, PCC. So I believe there's definitely growth potential, but there are challenges. And what are those challenges? So we have listed a couple of few of these challenges. Maturity of the market, we talked about this yesterday. Oliver from Principal Re, highlighted the relatively, lack of awareness of captive, PCC, etc. So this is a hindrance of growth. There was a debate on when captive, or there was a debate yesterday on when corporates should, whether corporates should look at the state of the insurance market when they look at captive solution. But I think we will all agree that a hard market would definitely help for the growth of the captive and PCC market as a whole. Cost differential. I think Ali talked about using cell as a more cost-efficient facility because it's cheaper. Costs are spread among the cell. But in this part of the world, in Asia, the cost differential is not that huge if you compare it to places like Europe. And there are many reasons because of the relatively lower cost structures that we have in this part of the world. And more importantly, the regulatory framework. Because the regulatory framework in Asia generally as a whole for captive is risk proportionate. So it doesn't cost a lot to run a captive insurance subsidiary, and hence the operating cost of operating a cell company, the difference would not be great as well. Local expertise and knowledge, we need people with the knowledge and the expertise to promote the awareness of PCC. So that's lacking as well, and those are the challenges that we see in the growth of the Asian market. All right. Yeah. So just a couple more slides to go. I spoke about the IRS market providing that growth potential to PCC, and Jose from AM Best spoke about the disruption to the insurance market as a result of influx of capacity from the capital market. So these are the statistics, and the chart on the left, will provide you with a historical snapshot of the growth in the alternative market over the years, and the growth has been significant. If you look at 2002, it was just below US 10 billion, and it has grown to more than US 80 billion at the end of Q3 2017. And the chart on the right would provide you with a prospective view of what's going to happen in future. And this chart was provided by EY, which shows that the percentage of alternative capital as a percentage of the total insurance capacity. And this is projected to grow from 14% in 2016 to 28% in 2021. So again, huge potential. So where is the growth, back to the question, where is the growth going to come for Asia? If you look at what happened in the US, 831B tax election, that's not relevant in this part of the world. So we believe that the real growth opportunity is going to be coming from the IRS market that's driving the demand for PCC in this part of the world. And this is based on the fact that increasingly we are seeing a lot more sponsors, investors, and insured perils coming from Asia. All right? So if you look at in Japan, okay, a lot of the Japanese insurers are using cat bonds to transfer the risk to the capital market, the Sompo, MSIG, Tokio Marine. And in 2015, China Re issued the first cat bond in China, which is called Panda Re, okay, which cover earthquake risk in China. And increasingly, with the growing of wealth in Asia, there's also an increasing demand from investors as well. So we do see a potential, and Labuan, as DG has mentioned, is the only domicile in Asia that has a PCC legislation. So being a first mover, we do see Labuan as a potential domicile that could be riding this next wave of growth. So just a couple of snapshots on Labuan as a PCC domicile. The protected cell company in Labuan, okay, can only allow currently to underwrite the following type of business: Labuan captive insurance business, captive takaful business, business as a mutual fund, and business as the Islamic fund. Okay, and in terms of the numbers, currently there are a total of 4 PCCs in Labuan, originated mainly from Malaysian companies. Total premium was $13.8 million US dollar as at end of 2017. And currently there are 18 cells with mainly owners from Asia regions such as China, Indonesia, Singapore, and Malaysia form under this 4 PCCs. So in conclusion, we are seeing a lot of growth, demand coming from IRS market, and we do see this as an opportunity for Labuan to be riding next wave of growth on the demand for PCC and driven by IRS market. I think what is lacking right now is the IRS regulatory framework. So that's food for thought for Labuan FSA. So with that, I'll hand over to Alastair to wrap up the session. Thank you very much.
Thanks, George. So there are a few minutes left. A couple of tasks. One is to ask a final question. Maybe we could just put that up on the screen right now. And while we're doing that and you're responding to that final question, I'm going to try to answer a few of the questions that have been coming in on Slido while George was talking. And some are in quite a detail about accounting treatment and such like, but there are 2 or 3 with a common theme about the legal challenge to cells that has happened in the past and whether they're still viable. So to the best of my knowledge, noting that Aon is not a tax advisor, and maybe we need to get Deloitte's back on the stage, they may have been challenged, but it's still a growth area. And if you think about some of them, especially the examples I showed of a clear pass-through, 100% reinsured out the back, there's nobody there, there's no substance, there's no mind of management, it's a facility, and there's no risk retained. So they're quite straightforward. And then when you look at the ILS type structures as a transformer, they're much more complicated. And some of the collateralized reinsurance companies now that we're running in Guernsey in particular have big staffs. They might have 25, 30 people there, all operating those big vehicles, and they're employed by the cell or the company now. So there's a variety of answers, but the good news is that although there have been challenges in the past, none have actually been terribly successful, and this continues to be a big growth area. So George adequately explained the insurance-linked securities opportunities, the way that the cells can be used to access those types of solutions. And that's happening all around the world just now. And it's a hugely expanding market, as he demonstrated. With regard to the other 4, they're all already available. To me, the big one was the second one, and it just being the mini captive, the risk retention vehicle for medium-sized companies that don't quite think that they're ready. They don't have the real risk appetite for a full captive. They maybe don't fancy the capital cost to get it up and running, or maybe don't fancy the long journey and the time commitment to get it there. So it's a good stepping stone. You can incubate the risk there and then set up a full captive and transfer your risk in there too. So there's 2 good opportunities for growth in the region. So the question's up there. Sorry, could we just put up the question and the answers to the final question? Okay, so the numbers are just starting to come in there. Good, okay, so the majority of the people that are responding seem to agree with us that this is a good area for expansion, in addition to all of the good reasons that we've heard over the course of the last 25 or 26 hours on full captives. So thank you very much for your attention, and we'll hold it there. Thank you.
Thank you very much. Ladies and gentlemen, round of applause for two gentlemen.